Welcome to the Options Income Blueprint Weekly Report. This is Michael Schulman on June 27th, 2022. We have a trading session tomorrow at 11, as we normally do. I'm going to go over the trades and results from last week, which were really quite interesting. A brief review of the market, and I want to continue the discussion that began last week about, in this kind of a market, the importance of selling calls. We only closed one trade last week. It was a new trade. It was a trade we put on and a trade we closed. It was Delta Airlines. For those of you who are new to hearing how we do things, I want to trade the airlines, but I don't want to trade them week after week after week after week. Their business is beginning to soften for the fourth quarter. Their balance sheets have taken a hit. They have significant problems in staffing and so forth and so on. And I monitor prices. It's the easiest thing in the world. You can do it yourself. If there's an airline stock or a group of stocks you want to trade, I check on Fridays. And prices which exploded are beginning to come down. For example, a $700 premium economy ticket to Denver a year ago, as I live in the Washington area, is now over $1,300, and it's beginning to slip a little bit. And last fall, I bought a ticket for Rome. I was there this past March. It was business class. It was $2,200. It popped up to $5,000. Part of its time of year, but a lot of it had to do with the post-pandemic travel boom. It's beginning to edge down. So we're going to trade. I've been trading Delta and United. We're going to trade it anecdotally. You can see we were quite busy, and the busyness was selling calls on shares we had acquired over the weekend that we were put, and we accepted assignment. And you can see the amount of cash that was coming in. It was huge. And that's why it is the topic of discussion today. You can see the potential rates of return from a cash point of view. And one of the things I want to discuss, which I really discussed more last week, was that you can say, oh, wow, my portfolio down, or let's say your portfolio isn't, but a specific position is down. What's done is done. And there's an emotional desire to fish and cut bait. It's just, I can't deal with this anymore. I'll take my loss and I'll move on. It's an irrational but normal reaction. It's an emotional but normal reaction. The issue is what's done is done in the stock market. The question is the story that was underpinning the stocks that you decided to own shares and sell calls because your puts have gone against you. Has that story changed? Are you really done with the company? And if you're not, and you're familiar with how it trades, and it's a screaming value, then you should hang on to it and sell calls. And that is the biggest emotional barrier. And I fall into this category too. You look at something and go, oh, this went against me. I don't want to look at it. And it's very important that these numbers that you just saw, this really large, gigantic flow of cash coming in, and these humongous rates of return, you need to take that and say, well, what's done is done. From the stock being, I was put shares and the price was above where the market price was, but I'm getting gigantic rates of return. I'm not going to do better going to another story simply because I'm frustrated. So the overall performance last week was tremendous. Between rolls and calls, you can see the amount of money. And it's exceptionally important in this kind of a market where, yes, it's been gentle or going up the last few days, but do you really ever know? I think we're going to be actually, and I'll discuss this in a moment, a bit of a lull until earnings. This is the way to go. Speaking of the market, many of us, at the risk of being rude, whatever, we weren't surprised in November with the Fed. We weren't surprised early in the year, weren't surprised, but it turns out enough people in the market were surprised. Hit the market very, very, very hard. So our surprises that surprise enough folks, professional traders really in the market, are enough of them behind us to see some calm and to trade on fundamentals. Now that does not mean the market won't go down. Surprises mean unexpected volatility. It doesn't mean direction. And the calm is important. I do see it until earnings. The first earnings that we need to think about is July 13th. Delta Airlines, which always announces earlier than the other airlines, and the banks. And both will be voting with their forecasts on consumer spending, which is what the street's really concerned about. And so this all adds up to, is the bear market behind us? No. We don't know. Technically, we could easily go down another 400 points on the S&P, 500 points on the S&P 500 before we hit some major support levels, or we may not go down at all. What would drive it would be continuing what is called compression of the price earnings multiple, the S&P 500 translation. There are big historical macro studies that show the S&P 500, when you put all the 500 stocks together and their value, and then you look at their earnings, there's a price earnings multiple. And right now, we're at historical norms, maybe a little higher, but we also have below average interest rates. We have negative real interest rates, meaning the nominal interest rate is, when you look at inflation, it's a negative real interest rate. So it's still too soon to tell whether there'll be more multiple compression. If you see concerns about a recession, and therefore a corporate or profit recession, meaning corporate profits will go flat or go down, then you could see more contraction, even if businesses are doing fine revenue-wise. And that's quite important. It's what started to hit us in November. All of this leads up to discussion of the importance of cash. Our focus has been for more than a decade cash returns by the week. Over time, we always beat market downturns. Now, this is a different one. This isn't short, sharp, and COVID-induced or geopolitical crisis in Europe induced or Ukraine induced or whatever. This is a rise in interest rates. And this is really the bull market for 40 years, starting when Paul Volcker, not Ronald Reagan, with all due respect to the president, Paul Volcker was the guy that led to the beginning of the bull market, the chairman of the Fed. The bottom line here is that bull market based on interest rates, that part is over. And in addition, we've had 25-year increases, a percentage of the gross national product that comes from profits. That too may be going sideways. A lot of that has to do with computerization and stock buybacks. And with low interest rates, you can buy back more of your stock, and so forth and so on. And with low interest rates combined with corporate profits increasing, you can buy back more of your stock. So corporate profitability is not an abstraction. It's not just a price earnings multiple issue. It's high profits over 25 years have contributed to humongous increases in stock buybacks, as did the Bush and the Trump tax cuts, corporate tax cuts. So the importance of cash is we beat market downturns over time, not in a week and not in a month. When you have this kind of a downturn, you have to be able to manage your positions with an undue concern about what the position of the portfolio, undue, doesn't mean you shouldn't be looking at it, but undue concern on Friday afternoon at 4. So if you do, and normally I say if you do 20 to 25% a year in cash, given market volatility and what you just saw from selling calls, if you do up to, and I'm not suggesting you can do this unless you're very, very aggressive, but if you could do 25 to 35% a year in cash, and you have a 20% market downturn, while everybody else is down 20%, you're up 15. The math is not particularly complicated. So this is the point I'm trying to make. Volatility, even though many of the positions that you just saw in that chart are underwater, I'm not really concerned. They're fabulous companies. GM, for example, will be a market leader in electric vehicles probably in about 18 months in terms of volume. You have companies like Marvel, which is selling at a fraction of its historical norm. You have Citigroup, which sold off with Ukraine for reasons not obvious to me, and so forth and so on. Pfizer is, one last one, is maybe the cheapest stock in the S&P 500. So with the current level of volatility, as well as our fundamental approach, which is great companies, folks, companies first, stock second, it's a stretch to think we might be able to go that high, but it's a doable stretch as opposed to a fantasy. And as I'm repeating, this is the way to go in this kind of a volatile and bearish market. And it was cash was king last week, and it was because of the rolls that we did of calls and of calls. So it's not like we're going, oh wow, the market is up, and yet I'm still down. We're going, oh wow, the market is up. The calls we sold are doing great. And One of the questions, I'm sure I'll get emails about this after people listen to this, is now some of our calls are in the money. So what? We'll roll them. We'll pick up appreciation, which is what we want. Or if they really get away from us, we'll just accept being called out and turn around and sell a put. This is the way you long-term manage a position. And how do you evaluate cash? You have to do a couple of things. This is highlighted over and over and over again in the six-figure portfolio coaching program, which used to be an independent program. We did a couple of 4 times a year, then 2 times a year. It's now part of the master's program. It's free. You probably, as we all do at times, measure performance based on how's my portfolio doing, and you may also see positions considerably underwater. But if you focus on cash and cash rates of return and show some patience, and I hate telling people to be patient about anything, your baseball swing, how to cook veal parmesan, or the stock market, doesn't matter. I don't like the term, but a long-term perspective lets you weather out bear markets, corrections, volatility. And it's important that you understand, if you're flashing, your cash is pouring in like it did last week, but you're still flashing red on a position, you only lose money when you close a position, not a trade. Trades are trade. Positions are multiple trades. When you close that position and say goodbye to a stock and you have a loss, that's a loss. Otherwise, it's a temporary or paper loss. And these numbers speak for themselves. And the bottom line is you can see how well we did. And there are different ways to do calculations. Sometimes I go back and forth with our editors, my editors, about these kinds of calculations. But the bottom line is very, very large returns on capital. The reason being that some people take a look at how much capital do I have in the position as of now, which is how many shares do I own, or how many did I put in initially in the position, which is how I like to do the calculation. And these are numbers without appreciation. And so the call strategy generating cash also has even a potential big kicker if you get called out. But it's not just calls that we did. I don't want to get too distant away from what we primarily do, which is we sell puts. And we haven't done real buy rights. A buy right is when you will go out, you buy shares, and you immediately sell calls. Most people in the options income blueprint service prefer selling puts, but I don't really care if we get assigned and we turn around and sell calls. Some of you do. I have to do the math and figure out how we're going to do best in the current market. So this emphasis on calls doesn't mean that we're walking away from some other things such as rolling positions, rolling puts, and so forth and so on. Just a little heads up that we're not becoming a call selling service. It's just we're there because some positions are underwater. And this all comes to something very important. Switching and saying I don't want to roll puts for no money, etc., that's cash focus. But the question is, what about stock and economy and forecast focus? Q3 is on the horizon. Everybody believes, and I agree. I have a Fed meeting, there'll be an increase of 0.75% in interest rates. And the earnings, as I said a few moments ago, are earnings that have interest to us begin July 13th. And we will continue to have a trading universe larger than normal. Normally, the trading universe for a quarter is my 25 stock bullpen. It's more now. And the amount of stocks that I follow and spend some time on has increased significantly because volatility has increased. You're seeing premiums that we can go for and sell deep out of the money puts and so forth and so on. The only issue I would add to this, besides let's keep the cash rolling in, is you will start right as we enter the July 4th weekend, and for the rest of the summer you will see liquidity begin to dry up on some names and they'll be too difficult to trade. So some very good companies that we trade all the time or we trade anecdotally, we may be slowing down on simply because there isn't enough liquidity in the chains, and there will not be until after Labor Day. So let's get our head around red portfolio in a position, green cash pouring in. Let's get our head around volatility. It's not going to determine the stocks we trade. It determines the tactics we use, which is that shift to calls on many stocks. And let's just keep that cash rolling in. This is Michael Schulman. Thanks for listening.